You ready, AJ?
Sure, dude. Go.
And welcome to another edition of the Nerdy Agent Podcast. I'm your host, Luke Pettersen, with my brothers and fellow nerds, Josh and AJ. Today, we're going to talk about the Q1 earnings reports. Fun in the finances, but first, we are going to start with the Would You Rather of the week. And let's see what Josh has come up with this week.
Would you rather play me in fantasy baseball or any other team?
Yeah, I was going to say, that's this week, Luke. We're playing Josh.
Wow.
Early lead on Monday.
I'd rather play Josh.
Yep.
I would rather, if I were you, I would rather not play Josh. He's currently sitting at 41-21. So.
Would you rather live in a house made entirely of glass or a house made entirely out of shipping containers?
I feel like this is so easy, but
I have a one question. Is the cost of each house the same?
I don't know.
It has to be for the would you rather, yes.
But the cost of the glass house is going to be significantly more expensive than the cost of the shipping
You can't have all these variables.
Well, the shipping container house is massive, right? 'Cause you have the same amount of money to work with when you're building the two houses.
Ooh.
Oh, that's kind of fun.
So you get a 400 square foot
Okay,
glass
guys.
house.
So have you seen? So we went to that dome for our 10-year wedding anniversary, and they are building mirrored glass cabins.
So cool.
Now that's what I would pick. Mirrored glass. So you can see the outside when you're outside, but you can see out from the inside.
Mirrored glass is not an option.
It's just a type of glass, just like you could have any shipping container you want.
Well, we're planning on building a 17 by 17 addition on the back of our house, and we had them come over yesterday to talk about it. And I was like, we just want windows, just here and here and here, and here and here and here, and all the way up. And so I would pick the glass as well.
I was going to pick the glass too. So
shipping containers suck, clearly.
I mean, shipping containers are cool. Have you seen they do those pods in backyards now with shipping containers? They'll do offices that they'll custom prefab for you and just drop in your backyard.
Those are actually pretty awesome.
Super cool.
Yeah, they're really
cool.
Or
there's entire little areas where they'll put a bunch of shipping container restaurants in. We're in Las Vegas, and there's a whole area where every restaurant is just built inside of a shipping container.
It's like food trucks, but shipping containers.
It's super cool. It's like a little shipping container park.
That's fantastic.
Fun.
Yeah. So, like I had said, this week we're going to talk about the Q1 earnings reports. To start, I was just thinking we have a few different companies specifically that we're going to talk about today. We're going to talk about EXP, Compass, Remax, Opendoor, Zillow, Offerpad. We might throw a few in there as well.
It's going to be a 2-hour-long podcast.
It's going to be a long podcast, but I want to give a brief overview to start. But before we do that, tell the agents why it matters that they know this stuff, right? Opposed to just being bored listening to this, not remembering any of this. Why do they need to know this and follow this reporting to be experts in the market?
So I think it's important to know, if you are at a brokerage, how that brokerage is doing financially. That would be something that I would and certainly do care about with EXP. But I think one of the most important things, and I listen to Rich Barton speak every time that Zillow has their earnings calls, I think one of the most important things that agents can do is know what's coming based on these calls. So they're not giving you the nitty-gritty details of everything they're going to do over the next 5 years, but the companies do talk in their calls about what's coming next, what they're planning on doing in the next quarter, how they're going to reach the goal and the estimates that they're trying to hit. And a lot of that signaling and that kind of communication indicates to agents oh, funny, or, oh, interesting, my brokerage is introducing this new lead gen platform, or we're starting a new website, or we're retooling this thing, or they're creating a new CRM. Zillow will get into it, but they're going to start doing a few things within their company that they talk about on the call that they're not currently doing. So it's always nice to know what's going on within the industry, whether it be real estate tech company specific or brokerage specific, especially when it comes to your own brokerage.
And there's trickle-down effects, right? So everything that's happening, you can kind of see how it's playing out and anticipate where things are going. So, for example, Zillow's seen their revenue come down from the agent platform because there's just fewer transactions happening this year. So as they do that, they still need to make up that shortfall. They're not just like, well, we made less money this year because agents sold fewer houses, so therefore we're just okay with that. So we've seen, in just our partnership with them and all the venues we've been to where they've been there, they talk a lot about Zillow Home Loans and Zillow Services and all these new things that are popping up. Part of that is just a natural, escalation of their business in terms of where their business would naturally go. But it gets accelerated when some other things are not performing quite the way that they would expect it to. Same goes for a lot of the brokerages right now, where they're trying to pivot into some other spaces because one space isn't working as well. So if you're following along with what's actually happening within the business model of either your brokerage directly or other brokerages, or even, some of the main real estate companies out there, you can see where some of the other things are going to be going in the future, which will A, make you more informed, but B, make you better positioned to understand how that could personally affect you 6 to 12 months from now.
So you can learn to pivot with the changes as well.
Absolutely.
So starting off then, the first point AJ made was understanding your brokerage. Our brokerage, for those who don't know, is EXP. So let's give a rundown of them to start.
So EXP, we got all these numbers here. So we'll go through some of the key ones. AJ and I will kind of bounce back and forth, and then we'll just add some commentary on each of these. So it's not too boring, me just reading numbers. They've seen a revenue decrease about 16%. Gross profit decreased year over year about 12%. Net income came in positive. It was actually expected to be about negative 5 cents per share, and it came in at positive 1 cent per share. So small profits for EXP, but they did actually turn a profit. Right now, you'll hear this as we get through the rest of the brokerages, but all the brokerages are really struggling because the interest rate increases have really tampered market activity. It's both slowed down the supply side, which we've talked a lot about on this podcast, but it's also just slowed down the number of transactions happening because people just aren't selling their homes.
I think the key, though, is that some brokerages are struggling a lot more than other brokerages.
Yes, it hits harder when your expense line is a little more tapped.
Robust.
So if you're growing on the expense side and all of a sudden the revenue line slows down, you can't just make the expenses go away immediately. It takes some time. So the balance sheet, at least at EXP from what I'm seeing, and once again, we are biased. We're with EXP. We like the company a lot. But the balance sheet's been pretty well managed. So there's a lot of cash on hand. Similar to last year, they're making money. Even if it's just a small amount of money, they're still making money. And they are paying dividends too right now. So overall, pretty solid. The last thing to call out, because agent growth is a huge piece of what EXP does. It's how they continue to fund their business moving forward. It's slowing, so 12% year over year to more than 87,000 agents in 24 global markets. So the explosive growth is slowing, but it's still positive. So where the market kind of, at least in the U.S., kind of seems like it's capped out, or it hit its cap around 1.6 million agents, and is kind of now coming down from that level, just based on the slower market that we've seen. EXP has continued to grow just at a smaller clip in recent months.
Yeah, and another dividend being paid out, which is great for us who are shareholders.
I feel like I keep getting dividend checks from them. It's fantastic.
Mm-hmm.
Small amounts of money, but it's money nonetheless.
Go out for dinner.
On to the next. So we're going to go through all the brokerages to start. The second one on here we had was Compass. Do you want to go that one again, or AJ want to take that one?
Hit it, Age.
Yeah, so the revenue decreased 31%. So again, when comparing, and we're not going to necessarily interject our opinions. We're just going off of these numbers. 31% down to $957 million. Transactions down 24%. Obviously, again, that's what our local market has pretty much seen as well. The 2023 Q1 GAAP net loss was $150 million. This actually sent the stock up because it was a big improvement from the loss of $188 million in the Q1 of 2022. So they are losing less money, which was seen as a positive thing. EBITDA was negative $67 million in Q1 compared to negative $97 million in Q1 last year. Again, another improvement. I think they've done a lot to improve their expense line, like Josh talked about. They've rolled out title and escrow as well, so something to know about, especially if you're a Compass agent. They're trying to integrate that platform. Again, they talk a lot about being an end-to-end sort of technology platform, more so than just a brokerage. So a lot of vertical integration happening. They're gaining some national market share. They're up 4.5% there. Agent counts at 13,515. That's an increase of 721 agents from Q1 2022. So again, a lot of growth in that space. And the company does focus, at least locally, on some luxury, higher end type stuff. Mm-hmm. So with less agents, they can still pull in quite a bit of commissions and revenue because what they're selling is really, really high end stuff.
Yeah, the one thing I think Compass does well is their agents are all good.
Mm-hmm.
Like every Compass agent I've worked with is a good agent, and so EXP is obviously really focused on just growing the agent count, but they'll kind of take anybody. Whereas Compass seems much more particular about who they let sit under their brand, so they do create a pretty positive brand experience. That I would say, if you probably surveyed most consumers would have a pretty favorable view of the Compass brand. It's marketed, it's branded really well, but they also just do have quality agents throughout the entire brokerage. The challenge I'm seeing here, though, is your loss continues to widen. They did do some expense reduction things. I think it was like Q2, Q3 of last year. So they're trying to minimize the cash burn. But we were only sitting on $364 million in cash. Some of that is a revolver. So they're continuing to like borrow more money to pay off these losses. But at some point, you really do become cash squeezed if they continue to struggle. The theme across brokerages right now is that when transactions are down, there's actually not much money to be made running a brokerage, right? We've seen it even on teams, right? A lot of people are like, oh, my expense lines, even on a much smaller scale, are getting squeezed because my net commission revenue is down because the market has just gotten squeezed and compacted so fast. So they're pushing into this title and escrow. Our team pushes into everyone's pushing into these two things, right? And it helps ensure you have some ancillary services that are they just elevate your profit per transaction. So everyone's looking for other ways to make money outside of just running a brokerage because there's just not enough in the brokerage business by itself.
And I think a lot of places have seen that title and escrow is the easiest ancillary service to replicate because it's not really that difficult. Mm-hmm. Whereas even mortgages, I would say, are a little bit harder to get into, maybe because there's a little bit more to it, a little bit harder to do. And I'm not surprised. I think we're going to see this moving. I mean, RE/MAX already has all this stuff kind of in place.
But you'll still continue to see it.
But you'll continue to see it across the industry. I'm going to be curious to see how that ends up playing out over the next 5-year period. Is it only going to be just massive title and escrow companies?
It's going to be interesting.
And
because,
mortgage lenders?
Yeah, lenders too, because all of the biggest players are getting into it too. So Opendoor is doing it, and Zillow's doing it, and the brokerages are doing it. So at some point, everyone's kind of getting squeezed, but there's only so many clients to go around. So where they end up kind of sprinkling is going to be interesting to see.
Well, and I think for Compass, the interesting thing here is I saw on the Inman article that their CEO talked about being free cash flow positive so that they aren't, to your point, burning through a lot of the cash and available credit that they have. And you put that they anticipate being profitable. So I assume he talked about that on the call.
In Q2.
So that'll be interesting to see if they can really flip that massive loss into a profitable type structure.
And that's probably why you've seen the stock price go back the other direction, is if they actually truly do accomplish what they're saying they're going to in Q2 and they see net profit even in a downturned market, it makes their business model seem more sustainable. Mm-hmm. Whereas there have been some people concerned that with just the cash burn, that at some point the business model was going to run out of money.
Well, that's kind of why a lot of people, even like you had said earlier, like EXP showing a very small amount is a very good sign because it means even in a down market, they can sustain.
Well, I think if you think about it from like an agent standpoint, and this is what I was talking about with my first bullet point and probably wasn't as direct as I could have been when we first talked about why this matters. But like if you think about your brokerage, if your brokerage is losing money, at some point they have to make money or they will cease to exist, right? So even if you love your brokerage, they're going to have to make an adjustment to try to exist. So Compass may be starting title and escrow to try to make more money so that they can continue to pay you what they're paying you today. But if that doesn't work out and they still continue to burn money and they're working on burning cash, at some point the agent splits would have to change in order to bring in more revenue to make the whole thing make sense, or they'll have to cut back on some expense lines and services they're currently providing in order to make it financially make sense. So that's not a Compass specific take. I'm just saying as you think about the way that these play out, it is important to know what the long-term potential repercussions are for some of the things that you're seeing in the notes. If they get to profitability in Q2, that means they've basically stabilized their business model. You shouldn't expect any changes. But if it's not, then that could result in X, Y, and Z downstream happening.
Totally.
Next one we have up is RE/MAX.
Josh, you want to take RE/MAX?
Yes, I would love to.
This would be the brokerage we're talking about. I mean, I think we did this because we've got EXP, which is our brokerage. Compass is a new up-and-comer technology type platform. RE/MAX is like the old trusty. It's been around for a super long time, so it's always interesting to see how they compare.
Yeah, you're kind of getting the new and the old school because EXP and Compass probably would speak to competing the most between the two of them.
And the models are completely different. So you can see like a lot of these revenue numbers are a lot different or a lot smaller potentially from a RE/MAX perspective because it's a franchise model, right? So this is not the specific brokerages, how they're doing. They're collecting franchise fees from local brokerages around the world. And that's how they're making their money, right?
Right. So their revenue impact is less, right? So decreased 6.2%. But on the upside, when things are really good, their revenue impact is less on the upside. So they basically have a more stable model,
Consistent,
within the larger company. Decreased 6.2% to 85 million, and net loss was 0.7 million.
700,000.
So overall, pretty minimal, but they are still struggling to maintain profitability. Slight increase in agent count, but that is coming from outside of the U.S. and Canada. So the U.S. and Canada is down 3.1%, but globally they're up 0.8%. And they're also pushing really hard in mortgage right now. So they've increased by 21% in terms of their Motto mortgage franchises, which is really interesting that you'd see more people getting into franchising on mortgage right now when the business is just kind of at a low point.
But I think there's so much capture rate to be had there if you can actually tie in with the right local franchise, right? And I think that's what they're probably seeing.
They also might be banking on the fact that in 2 years they'll be able to capture a bunch of refinances.
Yeah, down the road, right? If you can grow that business.
Well, they're like, you got to be open before, right? You can't just like open right when the refinance boom happens, right? You got to be open before that happens. You got to be up and running. So they might be trying to bank on the fact that down the road. I mean, even I saw a video the other day, and there were some people that had rates at 7 and 7.5. If they get to 6,
there's business to be had there.
There is, and so I that's gonna be interesting to see what happens with that. But that might be
part
of that.
I think the other thing to think about is the interesting thing to AJ's point about Remax is because it is a franchise-based model. The global company may be doing well, but the local franchisees may not be doing as well because they're impacted by the actual transaction count. So that could be a reason why maybe people are doubling down and saying, well, we have to get into mortgage. So I'm going to open a local franchise of the mortgage business while my brokerage franchise isn't doing particularly well. So that's a hypothesis as to why this could be increasing. But once again, speaks to a lot of people are trying to focus on the capture of the ancillary services right now, just because the base business is a lot tougher than it's been historically.
So gonna get out of brokerages, and if anybody listening to this ever wants like a specific brokerage or a specific real estate company included in this, send us a comment or DM us or find us somewhere.
Because we don't have Redfin on here. We could talk about Redfin next time.
If somebody specifically wants a company in Q2, we'll just add them to the list. We have no issue with that. But we're gonna get into the iBuyers and then finish up with Zillow. So the first one's gonna be Opendoor.
So they've made massive adjustments here. So the purchasing of homes is down significantly for them. I think that's just to kind of hedge against what they thought maybe would happen within the marketplace, because we've talked about it before, but these larger companies can't just shut something down and turn it back on. They have to like project and forecast and do all these things. And when the rates started to go up, their buying started to significantly slow down because, like all of us, they were concerned buyers wouldn't buy at all. And they're completely dependent on those buyers buying the end product. So their revenue's down 39% Q1 to Q1. Total number of homes sold is down 35%. We have it at the bottom as a key takeaway, but their total number of purchasing homes is down 81%. So that's pretty dramatic. Their gross profit was 170. And again, a lot of these numbers don't compare apples to apples, because when you compare a brokerage to an iBuyer, how the numbers get tossed in there are different. So they actually ended up with a net loss of $101 million in Q1 versus a net loss of $28 million in Q1 22. I would anticipate their numbers probably start to look a lot better in Q2 of 2023 than they did in Q1, because a lot of the sales happening in Q1 were the stuff they were buying back in September, October, and November, when the market was definitely a lot slower. And those closings, happened in January, February, and March. So will be interesting to see that. But we are seeing they're continuing to struggle to get that profitability at scale. And they've talked a lot about it before. I didn't listen to the call this time, but they talked about becoming more of a marketplace.
Yep.
So a place where buyers and sellers can come and actually
their founder
transact.
into the marketplace role.
Yep. So the old CEO, Eric Wu, is now running this marketplace structure. And I think they're kind of poised to, and we'll see how much money they got in their pocketbooks, because they've been well funded before. They're poised to try and create something that sort of competes with a Zillow, but from a less agent centric position, I think. So they're trying to get into a space where, they've been doing it forever. They're trying to eat at the commission market, by running this iBuying platform for one.
Yep.
But the marketplace structure could completely blow it up if they can figure out how to make that work.
Yeah, I think ideally they're going to say, okay, we don't really want to buy all these homes anymore. Their biggest challenge right now too is cash, right? So they're buying a lot less, partly because I think they're more nervous, but also partly because like they have like $4 billion in debt and they have like $2 billion in cash on hand, right? So you can't continue to just take on more debt and buy more houses. You have to spin some of them in order to free up cash to make it happen. But I think they're looking at it and saying at scale, we tried going all in and pushing our chips all in, and it, has, due to things maybe outside of their control, but has backfired a little bit with some of the losses they've been taking. So maybe we need to pivot into something that AJ's point is more of a marketplace structure. But to your point, it'll be interesting to see if they can do it. I think they're thinking of it more of like a large-scale FSBO type platform. And they're saying that, if we have all of this data. So whether or not we've made money or lost money over the last X number of years, we've learned a lot algorithmically and we've taken in a lot of data. So we can still give you a really good sense of how you could FSBO your property on this platform. And it would show only the houses that are kind of sitting within this realm of this FSBO platform. So if they can create a big enough number of homes on this thing, it could be kind of cool where people are like, well, I want to go sell my house. I'll talk to an agent and then I'll just go on Opendoor and see who else is selling in the area and if I can be interesting here and how much I can pay for this. And if you're buying a house, it might be kind of fun to search on Opendoor if there are thousands or hundreds of homes that you can actually buy from a FSBO standpoint. So it's interesting, if nothing else. I do worry about their cash burn and whether or not that makes them viable long term, but this is kind of a big pivot happening late into their company cycle.
It's a completely different company, essentially, is what
I kind of like the thought of the new company, though, right? And even like a bidding place, like where you could say I bid on all these houses that are available on the platform, and I don't do some. I think there could be some cool things you can do, and technology will make it easier to make it happen.
And I mean, we've talked for a while that having just a platform that only makes money doing one thing isn't always the best way to do stuff, right?
I'm sure they would have all their ancillaries though tied into
that's
the platform.
exactly
I'm
right.
sure they would.
If you're FSBOing, you don't have a lender. If
and
you're
I'm sure
FSBOing, you don't have
at the right price. I'm sure they'd still just buy it straight from the seller, right? I mean,
that's kind of what they're saying they'll do.
Is have to be part of.
They'll
this.
watch these houses on their platform. If they don't sell, maybe I'll just buy it from you.
Exactly. So the other key highlight that wasn't on this that I just want to make sure I pointed out, because I had seen 81% decrease in homes purchased is massive. I kind of figured if I typed in Opendoor layoffs, I'd find something. On April 18th, article came out that they laid off roughly 22% of the workforce, 560 positions. So they're shrinking from that standpoint, again, from a cash perspective, trying to stay afloat a little bit more. They laid off a bunch of people in 2022 too. So they're kind of condensing themselves a little bit, it seems like, so they can kind of wade through this part of the market, and maybe on the back end they can come out and do some things.
iBuying is just a very capital intensive type of company.
So on to the next one, the next iBuyer, who is kind of, are we good?
We're good.
I think we're good.
Who is kind of a condensed version to an extent of what Opendoor was, Offerpad.
So yeah, their revenue was also down about $70 million. Net loss was $59 million compared to $121 million, probably just a function of buying less houses. They sold 150 less homes in the quarter than they did the same quarter last year. They have these like contribution loss profit after interest per home sold. These numbers are always so funny how they do this, but basically their gross profit per home sold was $4,500 in Q1 this year.
That's just like what you bought it for and what you sold it for. So that's it. This second one is, I think, taking all the expenses into it, like holding and this.
But then they have the interest in there, which always makes it super interesting too.
Yeah.
Yeah, I mean, they're obviously not doing as well as they were last year, but again, it's sort of the same thing as we talked about with these larger revenue brokerages versus smaller revenue brokerages when like comparing to a Remax. They're just buying less, so their losses are going to be less, right? They're a lot more condensed company. They've always been a lot more thoughtful about which homes that they are buying. Whereas for a while, their Opendoor was just buying any house that got posted on their website. So Offerpad's probably going to see somewhat less of a volatile type numbers each quarter here.
The problem is though, if they're continuing to lose money and Opendoor's exiting the space and Zillow has exited the space, then at some point, it just becomes kind of tricky to justify their existence long term, right? Like if Opendoor can't make it work and Zillow can't make it work and they pushed at scale and Offerpad's still like, we're just trucking along kind of slowly, but we're still losing money. Investors are probably going to get spooked at some point here, in my opinion, but
So
it'd be interesting.
Let's rip through Zillow here.
I want to get one fun fact though. Here
Okay,
about
go ahead.
Offerpad. So I looked up ancillary services for Offerpad, and they actually they've went about it a little bit differently. They have services like carpet cleaning, deep house cleaning, handyman services, landscape, and pool
Interesting.
services, which is kind of fun. So that's a part of that. So we're going to take a short break to get a word from our sponsors, and then we're going to finish up with Zillow.
All right. The Nerdy Agent Podcast is brought to you by the Advisory Realty Group at eXp Realty, where we mix an incredible staff with awesome systems and amazing opportunities for our agents. If you want to learn more about the Advisory Realty Group, visit us at theadvisorymn.com or shoot us a DM on your favorite platform.
All right, and we're back. We are going to finish up with the real estate monster, I would call them. Not monster in a bad way, but just they're a really big company.
Large.
Finishing up with Zillow. What do you guys got?
So go ahead, Josh. You got it.
Q1 revenue, $469 million. They talked about how it was above the midpoint of where they were kind of hoping to be. So they did increase above their expectations. Residential revenue's down. So like everybody else, they're down 14%. When they say residential revenue, that's pretty much their transactions driven by Premier Agent revenue. Because total industry transaction dollars have declined 27% year over year. So interesting fun fact if you want to think more broadly about the United States market versus your local market. Premier Agent revenue decreased 16%. That actually is better than they thought it was going to be, because if you think about it, the total market transactions are down 27%. So if they're only down 16% on the Premier Agent platform, that means the people that are on that platform are outperforming the broader market. They had expected 23 to 28% down, which is in line with where the full market is. They are increasing their rentals revenue, so that was interesting to see. We advertise our rentals on Zillow, but we don't pay for it. So it is interesting that they switched it from everyone pays to like you can choose to pay, and they're making more money.
So one of my clients actually just did this. He said that he posted on Zillow and then he paid for the boost.
Yeah.
You can like
Did
boost
it work
to the
though?
top. He said he got like 70 people to reach out.
Maybe I'll do that for our next
But
one.
I feel like 70 people reach out every time most of the time.
Yeah,
anyways.
I don't know. We'll try it maybe. But
It's a cool idea.
It used to be $10 a week to advertise on Zillow. Now it's like $30 for a one-time fee. So if it's
I
working,
like that better.
yeah, you can choose to do it. You don't have to.
Mm-hmm.
Their mortgage revenue is way down, but that whole marketplace is way down, so it's hard to say if that's working or not working. Zillow has been pushing their home loans program pretty aggressively into the marketplace, wanting to make sure they continue to pick up market share. It's a tricky model to work on remotely, but they are continuing to make that a priority within the company. And then, so the other thing I like to call it with Zillow, it's important, I think, as an agent to know this number, is the traffic to their apps and websites, because that's very, very indicative of what you're going to see in terms of buyer behavior. If there are more people visiting Zillow, you tend to see more buyers out in the market. If there are fewer people visiting Zillow, you tend to see fewer buyers out in the market. So they were actually at $2.5 billion, which is a crazy number, but it's down 5% year over year. So similar to what we've kind of seen, the transaction volume, the general interest in buying right now is down, likely tampered by the reality of the interest rates.
But 5% down is less than I thought that would be.
People still love to just browse.
They
even
do.
if they're not wanting to
A couple
buy.
things to point out here, though, on that is this is total visits. So 212 million average monthly unique users, 2.5 visits. It'd be an interesting stat to track is how many visits per unique user.
Yeah.
How is it
So
going up?
that might be going up because it's harder to find a house right now. So
Yeah.
people might be making offers, losing, and then going back onto the website to find more houses.
They're sitting around.
And maybe last year it was the same. It's, I guess, really hard to say with what was more competitive last quarter, like Q1 2022 versus this year. But interesting stat to know is that's like 12 visits per user, right?
We should do a podcast on that. What was more competitive, Q1 of 2023 or 2022?
The other thing that I want to point out too, though, is they've got $3.4 billion.
They have a lot of cash.
So what's going to be interesting here is, and they pointed out, and I think we'll probably get to it, but they're pushing into like the AI space, and they're going to pilot that in a couple markets. Rich talked about that on the call. $3.4 billion. They could do a lot of things as far as buying other companies. We've talked about.
They're doing a lot of share repurchase too. So they've already bought a lot of that, but yeah.
It'd be interesting, right? I mean, like they're probably going to be purchasing some distressed assets in the next 12 months, I would imagine, We've talked about Super E-Key as a really good target for them. I'd be shocked if they didn't get into that space somehow. But again, they're showing you, granted, they did lose money, right?
Mm-hmm.
Some money.
Yep.
But they've got so much on hand that they're poised to be around for a very long time. And a big reason why, I think, and we went through a couple of these segments, they've got revenue coming in from a lot of different places. So they have many different streams of income, and that's helping them to offset some of the ones that aren't doing as well.
Right. Yeah, like Showing Time, for example, when they bought that, they're really focusing on integrating it in. So I do at least, once again, we talk about our biases all the time. We're big fans of Zillow, but the work they're doing to continue to try to make it a more consumer-friendly platform is pretty cool to see. Like, I'm excited to see what Showing Time Plus's future will be in terms of plugging directly into the client experience. And just the things that they talk about in terms of their partnerships with future agents. I think there's a lot to like there. I do talk about how the traffic to the website is indicative of there's fewer buyers out in the marketplace. So it would have been interesting if there was more inventory in the market right now. Theoretically, that could create more buyers. That would cause the market to still be crazy, but it would suggest that if their inventory wasn't so challenged, we'd be more of a buyer's market right now than we're seeing. So keep an eye on that metric and continue to look at every quarter. I would say in terms of like how you view these metrics and what's important for the brokerages, it's all about agent count and growth there and who's there and are they making money, because that will impact whether or not your future splits might be hit or not. And for companies like Zillow and Opendoor, it's about profitability, but it's also just about utilization. Are people using it? Are they buying more? Are they selling more? They tend to be much more important measures to be tracking. So if you want to just simplify everything we talked about to like those few bullet points, those are the most important things, at least that I'm paying attention to.
That was the final thing I had on here, the 1 to 2 things that agents can remember about these reports. So that was Josh's.
Got ahead of myself.
If you were an agent listening to this right now, what is something from this that you can say, I'm going to memorize that, and I'm going to be able to use that with a client or with friends or with family to be the one that actually is the expert in the real estate market? They look at you and they go, that guy knows what's going on.
I think, talking about the brokerages is fine. That's more of a industry type conversation that you'd be having. I think it's more about talking about Opendoor, Offerpad, Zillow. Everybody knows who these companies are. So talking about the fact that, Opendoor bought 81% less homes in Q1.
That was my stat.
That's a really interesting number to know, and to tell people, well, they did slow down their buying, and here's a big reason why. The rates went up and they shifted their analysis, and we'll see now as the market has picked up and the prices continue to appreciate, at least in some markets. Do they really ramp that back up and start buying more homes, or do they lean into this marketplace type feature? But you could glean a lot of cool stuff off all of these companies. I just think, again, not to harp on it, but I think the Zillow, the way that they're running a business with 5 different streams of income or however many they have now is super fascinating, because they've got so many more levers they can pull to make money from different ways, right? And they can shift employees from one thing to another rather than just, and they've laid off some people too, but rather than just laying off 25% of their workers, they can say, hey, you're really good at doing analysis. I'm going to shift you into the mortgage space now, or I'm going to shift you into the rental space now, or what can we do?
We have $3.4 billion. We're trying to buy something. Go find us something.
Exactly. So they for sure have M&A type people within their organization as well that are actively pursuing opportunities like that. So just cool to see companies doing things in the right way.
They also start with the consumer and work backwards versus start with making money and then work to the consumer. Yeah. So I do feel like the iBuying is we can make some money doing this. We just need to figure out the best way to do it. But that's not always thought about from the consumer's perspective about what they want. I think consumers want iBuying, but the way it's currently structured does not exactly work in terms of the consumer experience.
It's super interesting because one would argue that what Zillow is doing, again, trying to remove my biases as much as possible, what Zillow is doing is trying to create something better for the consumer.
Yep.
But if iBuying does work successfully at scale, you could argue that it's worse for the consumer because it means that they're buying houses from people that could have made more money selling their house on the open market.
Yes.
Theoretically.
Yeah, a simpler
simpler
buying process that eliminates agents is something that I think consumers would actually want.
It could work.
So the marketplace concept is something that I think does make sense for consumers. But yeah, to your point, like mass scale flipping, you're just kind of doing low-end renovations and selling houses for more than they would have been able to buy and flip themselves.
So I'm gonna throw out one more. The 2 points that I had from this was, if you're talking to somebody that comes up, Opendoor bought 81% less houses in Q1 of 2023 than they did in Q1 of 2022. That's just a big number, and I think that's a fun one to be able to share. The other one is, I would say, if Zillow ever comes up, you can talk about the fact that they're pushing title and they're pushing mortgage, and they're really trying to get hard into that space in the real estate market, because I think that the general consumer, your friends, probably don't know that they're trying to do that.
Yep.
And so it's something you can add.
And even though the
things.
market feels crazy right now, Zillow's actually seen a 5% decrease in the eyeballs on their site. So it's not that there are just a billion buyers out there. It's that we're really supply constrained.
I like that one too. That's a good finish. That's all we have this week on a little bit longer episode of the Nerdy Agent Podcast.
Super nerdy.
As always, folks, remember, be better.